Good morning, everyone. We're just going to wait just a minute for people to come on. Everybody's having a good day. All right, and we'll get going. So good morning, everyone. My name is Josh Strittmatter, and I would like to welcome you to the Strittmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation today is titled Behavioral Investing and Athena Global Tactical ETFs. For those of you that don't know us, we are a Strittmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. If all of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in, and we'll be happy to answer those questions for you. We'll also be sending out a replay of today's webinar via email. So if you miss something, don't panic. You'll have the ability to watch it again. We also post it on our website, so you can also go to our library of webinars on the website. And you're welcome to forward these presentations to whomever you would like to do so, if you think that would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professionals before taking any action on any of the information in this presentation. For more information, including key disclosures, please visit us at our website at strittmatterwealth.com. Now let me introduce our speaker today. Dave Stock is with Athena Investments. Dave graduated from the United States Air Force Academy with a Bachelor's of Science in Engineering. He served 10 years in the Air Force as an F-15C fighter pilot, Air Liaison Officer of the Army, and a glider instructor pilot. Served 2 tours in Iraq and was awarded the Air Medal for 32 combat missions and 122 combat hours flown over southern Iraq. His final assignment brought him full circle back to the Air Force Academy as a glider instructor pilot for advanced aerobatics and spin training. After receiving an MBA in finance from the University of Colorado, Dave switched to finance in 2006, and he joined Athena in 2013 as the Director of Advisor Services. He oversees national accounts and platform sales and works with hundreds of advisors integrating Athena strategies for their client portfolios. So without further ado, let me introduce to you Dave. Dave, thank you for joining us today.
Thanks, Josh. I appreciate the introduction. It was a more than generous introduction there. Let me get my screen shared. So can you see my screen, Josh?
I can.
Okay, excellent. Thank you so much for the introduction. Like Josh said, I've been at AthenaInvest since 2013, working as the Director of Advisor Services. So I have a kind of a multi-hat role there where I do a lot of sales consulting. I do some of the investment analysis, trading at the firm and everything. And I just want to tell you guys a little bit about Athena, who we are, what we do, and kind of our philosophy and how we approach the markets, and our how we work with Josh in that regard. So we are an investment money manager, and we help Josh with a part of his investments for his clients to help manage some of the equity exposure, so in the stock market specifically. We do that through behavioral investing. So we're a behavioral shop. We look at behavioral metrics. So we're a little bit different than a lot of other people that other firms and other managers that you've heard of out there. So keep that in mind as you're going through this. What you're going to hear is probably a little bit different than anything else that you've heard out there. So without further ado, I'll just jump into the presentation here. So today's discussion is going to include why behavioral finance, what is it, and then some stock market attributes of kind of looking at the big picture, the long-term view of the markets, and then really looking at the Athena Global Tactical ETFs, which is one of the portfolios that we manage or that we use to manage some of the money with Josh. And then I'll go into some current outlook. And I'll try not to get too much into the weeds. Please feel free to shoot questions over to Josh and his team, and then they'll get them to me, and we can get those answered at the end here. So why behavioral finance? So one of the big things we look at here is investor cognitive errors. So these include, I'll go through a couple, the main ones: myopic loss aversion, social validation. So there's a lot of research that's been done on the behavioral side of things. Why do we make the errors that we make, right? Why do we have cognitive errors that cause us to make decisions? And it goes down to a lot of the Michael Lewis wrote a book, The Undoing Project, which really gets into the research of Daniel Kahneman, understanding that whole thought process of why we make decisions. Some of them are fast, some of them are slow. So there's fast thinking and slow thinking. So Thinking Fast and Slow is a good book by Daniel Kahneman, although it's a very challenging read. But it is, they do really go into some of those cognitive errors. So myopic loss aversion is, for instance, we feel twice as bad about a loss in the market if we lose money in the stock market as we do the equivalent gain. So if we gain the same amount of money in the stock market, or we lost the same amount of money, we would feel twice as bad about that. So and we have a very myopic view of that. So we're very short-term oriented. So if that happens over a very short-term time period, that can be very dangerous to our decision-making process, because we'll make decisions that cause us to get out of investments when we shouldn't. Social validation is another one. We always want to do what other people are talking about. We go to a cocktail party, we talk about Apple, we talk about Google, we talk about Facebook. What are those stocks doing? Well, I should own those. I should have those in my portfolio. Well, maybe those aren't the best investments right now. Maybe they were, but that's kind of social validation, how that works. And there's a ton of other different cognitive errors that we can make that, cause us to make mistakes in the market. And these are just behavioral investing mistakes. And they can happen across all different aspects of life, especially within finance. So how do we avoid those? And how do we kind of, break away from that so that we can invest in the stock market over a long period of time? And the big thing is portfolio planning. And this is where Josh comes in and his firm at StripMatter, where we can separate the concerns, essentially. So we separate the anxiety, we separate the concerns into different buckets, if you will, so that we can create high confidence outcomes. So liquidity is one of the big buckets. You do have a stable principal. We don't want to lose any money. That's the cash that you need to pay your bills, to take care of your day-to-day living, over the next 6 months to a year. You have a car you're going to purchase next year, things like that. Income is the second bucket. We need to fund ongoing needs on a monthly basis. This can be done in multiple ways. From the income from your work, it can be done through Social Security. It can be done through variable annuities, bonds in the market, anything that's going to result in some kind of income. The key here is that once you take care of those two buckets of your liquidity and your income needs, then you can help to establish a growth bucket to accumulate wealth over a long period of time. And so the true goal of that is to accumulate wealth, to grow your long-term wealth and not be worried about it. If you can separate your anxieties, your emotional cognitive errors that you can make in the markets from that, then that makes it so much easier to be able to do that. Your biggest risk when you invest in the stock market is underperformance over time. And a lot of the behavioral mistakes that we make can cause that. So what is behavioral investing? So there's a lot of Nobel Prize winning research out there from behavioral researchers, including Daniel Kahneman, Robert Shiller, and Dick Thaler, who have all won the Nobel Prize for their work in behavioral investing. Daniel Kahneman for prospect theory, Robert Shiller for market volatility, and Dick Thaler for behavioral nudging. If you guys have watched The Big Short, that movie, Dick Thaler actually made an appearance in there and talked about some of the behavioral investing pieces of what was going on in the 2008 crash. So some key conclusions that we can find from this basic research is that people are not rational. We do not make rational decisions in the market or in our life in general, and a lot of different things that we do. And that's just the way that our brains are hardwired over time. So therefore, we think that markets create inefficiencies, and those inefficiencies can be capitalized on in the market. And so we built this kind of as our foundation for behavioral investment management. So the foundation of research, we look at the markets and we think that the investors and market participants are rational. They can make make inefficiencies from the irrational mistakes that they make. And so we think that we can build portfolios to capitalize on that. So we have several different patents. Our firm was started by Professor Tom Howard. He's a professor emeritus at University of Denver, taught there for 35 years, a PhD in finance that he received from the University of Washington. So he did a lot of research in the late 80s and early 90s starting to move towards behavior and said, well, how do we use behavior to actually build portfolios? And so we've done a lot of research along that. He's written 3 different books on the bottom left. And then we have several patents that we have on how we manage money within our firm. So jumping forward into kind of some bigger picture stock market attributes of how things are looking in the markets right now. So, your risk and growth assets. This is just a chart that's done for the S&P 500 from 1950 to 2018. And it gives you the S&P 500 in the blue line, T-bonds, which are treasuries. Those are in the orange down here. And then you have T-bills, which is essentially cash, and then CPI, which is your inflation. So this just shows you your rate of return during that period. And this is over a 68-year period during which you would have gained only, inflation was at 3.1, bonds gave you 5.6%, and the stock market gave you 10.8. So you can see that exponential growth of compounding over time is where you truly gain an advantage in the stock market. And your true risk is that you leave money on the table. So if that's the case, then T-bills or cash essentially is the riskiest investment over time. And that's due to inflation and keeping up with the economy and other things that happen in the stock market. So we think about volatility and tail events. And volatility is just the up and down movements in the market. And if we look at the chart on here, this is kind of a distribution curve. It has all the different years in there since 1926, and whether it was a negative year or a positive year. So since 1926, the US produced positive annual returns 74% of the time. And when we look at this, most people used to use this chart before 2020. Most people would say, well, hey, where's 2008? And so we'll kind of go through that really quickly here. So 07, 08, that's a big negative year. Everybody remembers that year. And of course, now everybody, I think, remembers 2020 as a more recency bias from that. But if you go through, look at all the other green years that have happened since then. And 2018 was a negative year. And then 2020, even with the COVID crash, was still a positive year between 10 and 20%. So that kind of shows you over that time, you're drawing from a distribution of returns. That's all we're doing on a yearly basis. And so 74% of the time, it's going to be positive. If I was going to a casino, those are pretty good odds in your favor. So those are the things that you want to look at over a long period of time. And it takes a big investment horizon. Again, it goes back to that myopic loss aversion and really focusing on not the short term, but the long term. So when the market hits a new high, what happens next? I throw this up there just because this is a behavioral advisor thing that we did for clients back in 2020. Said, well, when it hits a new high, what does it do next? So 56% of the time, you're going to get a new high the next day, no drawdown. So over half the time, it's going to just keep going up. 42% of the time, it's going to pull back, though, up to 10% of a loss. So right there, you're looking at 98% of the records are in that category. Then 1% at a time, you'll enter a correction from 10 to 20%, and then 1% in a bear market. So right now, we're in that 1%. We were actually in 2020, we were in that 1% of bear markets then. We recovered actually really fast out of that one, and much faster than any bear market in history, actually. But in this case here, we're in a bear market again right now. Do we know whether we're going to recover out of it right now? No one knows for sure whether June put in the low in the stock market. So only time will tell. What we do know is that on average, it takes about 4 years to a new high, and average drawdown is about 36%. Right now, the market's hit about 23% is the max drawdown that it hit, which is the furthest from the high to the low, essentially over that time. So that just puts a little bit of context into what might be next in the market. So this is a little bit closer look at different bear markets from 1950 to 2021. So since 50 to 21, over a 70-year period, we've had essentially 10 different bear markets, not including this one that's on here. And this just tells you what the actual drawdown was over that time. There's the 35.6%, the average here that I talked about in terms of the top to bottom. The thing to understand here is, peak to trough. What's interesting is the two peak to troughs that were very quick were 33 days in 2020 and 100 days in 1987. If anybody remembers, 1987 was the Black Monday. crash in the market. So it happened fast. So it took only 33 days in 2020 and 100 days in 1987 to reach the bottom of the market. So the average is about 426 days, so just over a year. So odds are that we probably haven't seen the bottom of the market yet, just based on looking at the number of days that were there, as well as the average drawdown. That doesn't mean that that's the case, though. This could be certainly shorter. You know, some of the shortest ones are 21 and 22%. So just kind of keep this big picture in mind when you are looking at the market right now. And then we talked about kind of how fast some of the bear markets can enter. You know, the COVID crash, it entered within 16 trading days. Black Monday was 38 trading days. The crash of 29 was 42 days. Right now, we entered the bear market at 111 days, trading days. So from the beginning of the year through, I think it was sometime in May, when we actually entered bear market territory. So this kind of gives you a context of, you know, how long it takes to enter into the bear market, which means that you're down 20% from the high, the way we've defined it on here. So now let me jump from big market picture to one of the portfolios that we manage and kind of give you a better understanding of how we look at money, how we help Josh and his clients, and how we go about that from a behavioral perspective and applying those principles to what we look at in the markets. The Athena Global Tactical ETF is essentially, our objective is to maximize your long-term growth with market selection and leverage. We have a market rotation approach to it based on our deep underlying behavioral current. So we're looking at a deep macro level crowd behavior and trying to figure out what is the crowd doing on the way up and what is the crowd doing on the way down, and what is the general exposure of market participants at the time. So within that, we can invest the portfolio in small cap, large cap in the US, or international equities, and depending on the strength of the signal. So what are we're measuring investor behavior, and why do we do that? Or actually, what is it first? Investor behavior is just, we're looking at investor factors. So what's driving the stock market? What type of factors are driving the stock market? And those are essentially anomalies or things that they talk about, you know, whether it's growth stocks or value stocks or competitive position stocks or risk stocks. And I'll get into that in just a second, but it's the factor that we're looking at in terms of what's driving the actual stock market return. And then why do we measure that? We think that it gives us a little bit better understanding of the overall market's underlying strength or lack thereof in its potential current return. So from that, let me give you just a couple examples of how what we're looking at for return factor proxies. So we look at, we've taken the entire investment universe on the equity side, so in the stock market, and organized it by 10 different strategies. And those 10 different strategies, these are 3 of them: future growth, competitive position, and risk. And these are essentially, all we're doing is finding out what managers out there in different mutual funds that manage money, what are they looking at? What are the key factors that help them get an edge in the market or to produce alpha, produce an excess return for their clients? Future growth, they're looking at company growth, earnings growth, sales growth, etc. Competitive position, what kind of companies have formed a moat? They have barriers to entry, they have a defensible market position, strong fundamentals, strong innovation, things along those lines. And then there's also risk, which is kind of on the other end of it. Those are managers that really want to limit volatility. So they want to limit the up and down in the market. They look at a little bit of geopolitical and business risk, and they're trying to limit your downside. So what's interesting about this approach is that if you look over a long period of time, this is 1980 to 2018 out of our database, and you organize by those 10 different strategies, you say, well, which ones do the best over a long period of time? Because that's where I want to focus my money from a strategy perspective. But then also I want to look at this to see how the market is doing right now. So future growth and competitive position are by far the best performing strategies. On the other end of the spectrum is risk. They underperform by a significant amount over a long period of time. So those are kind of the strategies you want to avoid from that perspective. But this tells us something about how we look at the markets. So over that time, I talked about the ranking here, 1 through 10 of these strategies. All we're trying to do is figure out, is the current picture right now aligned, mixed, or inverted? And that kind of gives us an expectation of returns in the market, high, medium, or low. So essentially, we're organizing by return factor. We measure the preference of market participants by that historical ranking versus the current ranking. And then we can transform that into expected returns or what we think the market might get. It doesn't guarantee anything up or down in the market, but it gives us an idea of what the market might produce over the next year or so. So here's expected returns and market exposure. From what we're doing is essentially saying, we have a normal distribution curve that I showed you earlier with each of those years of the returns in the market. We're just trying to figure out if that curve is shifted a little bit to the right and we need to be opportunistic, or has it shifted to the left and we need to be a little bit more defensive. So over time, our actual investment results, we've been managing the strategy for just over 12 years now. Since inception, we've outperformed the market by about 16% annualized versus 9% or so in the market. On a 10-year basis, about the same, about 15 or 16 versus 9. So over the long period of time, we've underperformed or outperformed. Over a short period of time, over last year, we've underperformed the market, and year to date, we're just above the market right now. And this is as of 6/30. And here's just kind of different graphical representation of that same performance. And you can kind of look at the yearly returns of the market here versus the benchmark, which is the broad Morningstar Global, which is essentially the all-cap world index. So then you might ask, well, what is our current outlook on the market? How are we seeing things and what's going on right now? And what we've seen with the U.S. market barometer, which kind of controls a lot of whether we're invested or not in the market, was declined a little bit into the COVID thing. We went to a cash position then for a couple months. It was the wrong decision. We underperformed for a little bit. And then it got us back out. We went back into small caps for a while. That's a pretty good performance. And then slowly that indicator since last fall has just fallen apart, and it's gone down over that time. We might see it start to turn around and improve here, but we're definitely seeing a deteriorating underlying environment in the overall macro picture in the market. And that's just looking at it from a behavioral perspective. So time will tell whether this starts to turn back up and gets us back invested, but our portfolios have moved to a more defensive position in the market right now. So our defensive positioning is in cash. So essentially, why are we in cash? Investors are showing a high preference for low return, risk mitigated strategies out there versus a low preference for higher return oriented strategies. So that's kind of a strong negative behavioral pattern that we're starting to see, which is why we have a cash signal in the portfolio right now. So the barometers and what we do, they're not priced on price level. It has nothing to do with it, whether the price is going up or down. It's just what the underlying behavioral current is in the market. And then what we have found over time is the longer the cash signal lasts, the more likely it's to benefit the portfolio over time. So kind of in summary here, just looking at the big picture from an economic standpoint, fundamentals, everything, all put together, the opening and closing of the economy with COVID in March 2020 was highly disruptive in lots of ways. Supply chain issues, all kinds of other stuff, massive spending from the government. And people talk to me and they ask me about inflation. We have a high inflation. We haven't had that since this high of inflation since 1980, 1982. And all through the 70s. So why are we having that? And honestly, if the government prints a ton of money, and then or I should say the Fed does, and then the government spends that money without anything to back it up, that creates inflation. That is the only place where inflation comes from. It's from a monetary policy. And so that's something to understand from that bigger picture. It's going to create a more volatile environment, I think, for who knows how long to come right now, because they have to get the inflation under control. Because if you don't, you end up like Argentina or Germany in the 30s, those kind of situations. So right now we have kind of a mixed environmental condition across the board. High inflation, tightening monetary policy, weakening economy. We're kind of, technically we're in a recession right now. And a bear market. So all those kind of things, those are the summary of what's going on. And then we have a deep behavioral current that's negative right now. Can those things turn around and improve? Yes, the market is forward looking. So 6 months from now, it'll be completely different conditions, and we could be back invested within a few months in the market. We analyze our signal on a monthly basis, so we can determine whether that is. I think that's pretty much it. Let me see. One other side in terms of successful investing, we look at it and say, well, what is the most successful thing over time for the client to be able to do? And first is to insulate your investments from your emotions. So we talked about those cognitive errors that you make in the decision-making process that we go through. You have to insulate your investments. How do you do that? You hire an advisor. You hire Josh to manage your money. You hire him to take care of that and to help you insulate your emotions, to help keep you in check, if you will, over that time, over the time in your portfolio. So if you separate the long and short term needs that we talked about, the bucketing approach, you can minimize your emotional impact on that. And then you structure it for a high performance growth portfolio to build long term wealth in that actual equity bucket or long term growth bucket for your management. And then earning excess returns through truly active management that works over time. One other thing, this is posted on our website on a monthly basis. This is kind of our market view, behavioral, economic, valuation, technical. They're kind of showing normal right now, although some of this is kind of leaning towards the weak side, and more numbers can continue to come out on a weekly basis showing that. So from that, I'll open it up for any questions. Again, please feel free to drop those into the chat box, and we'll get you set up. Josh?
All right, thank you, Dave. Great presentation. I'm gonna switch screens here real quick. So again, as we wrap up, if you have any questions, feel free to type those into the chat box. And I'll have a couple of questions for you, Dave. But first of all, if you'd like more information, you're welcome to reach out to us as well at 817-210-3444 or email us at clientservice@stripmatterwealth.com. You can also go to our website, stripmatterwealth.com, to sign up for our weekly market updates and e-newsletters. We also have an events newsletter that you can sign up for future events to receive information about future events. And then also join me on Saturdays on my show, Ask the Experts, at 10 a.m. on 1190 a.m., where we answer your financial questions. So that said, folks, if you have any questions, again, type those in. Dave, one of the things that was interesting to me about your presentation is that you guys have been basically in treasury bonds for how many months now? Is it 2 or 3 months?
Since mid-May, so 3 months now.
Yeah, 3 months now. So, and it looked like your indicators is still showing that we're probably not close to being reinvested soon. Is that a fair assessment?
Yeah, we'd have to see some pretty significant improvement in it over the next couple of months here for us to get. So we'll definitely be in for 4 months now, through mid-September at a minimum.
Yeah, and he's making changes quarterly, correct?
Monthly.
Monthly?
Well,
okay.
It has the possibility of monthly changes because we look at the data on a monthly basis, but usually we don't trade but every 4 to 6 months. So it's maybe 1 or 2 trades a year. So
is there a day that the portfolio is traded?
It varies.
So no specific day, like at the beginning of the month, as an example?
Yeah, 10th and the 15th of the month is typically when we do it. It's end of month data, which we get from Morningstar, usually by the 5th of the month, and then we have to run through our algorithms, put in our database, make sure everything looks correct, and then by the 10th, usually we'll know one way or the other.
Gotcha. And then we usually get an email from you soon after.
Yep.
And then we try to communicate that to clients as the changes are made. So interesting. Yep. And one of the things that's interesting to me is how much he has beat his prospective benchmark over the years. And I know a lot of that in my mind is because he's taking concentrated positions in a certain asset class or sector. But it's interesting what concentration does for you. Do you have any comments on that?
Yeah, no, it's funny because most advisors, most firms, analysts, they say you need to diversify. Well, people diversify so much that you end up with a complete basket of mush. Global mush is what we call it, where you own 2,000, 4,000, 5,000 stocks across the world. You own overlapping mutual funds that all own the same stocks. And you're not going to get anywhere. I mean, you're going to perform in the market. Might as well just buy the SPY ETF.
Yeah.
I mean, you're not going to get any outperformance, and you're probably not going to get any underperformance, but you're going to follow the S&P. So make it simple on yourself. and just buy the S&P and pay, virtually nothing for it by doing it through one of the ETF providers. So the alternative to that is to say, well, can we find mutual funds? Can we find managers that can do can be truly active? And an interesting point to that, Josh, is you talk about underperformance, right? Most people think that active management underperforms, and it's actually kind of true. 85% of active managers underperform. That's a study that the professor did. And so he couldn't figure out at first. He's like, I don't understand. If that's the study, 85% underperform, then how can any of these guys produce alpha? And what we found is that if you follow a specific strategy, a detailed process, you take high conviction positions, and you stick to your plan, that over time gives you the potential to outperform. What we found is those 15% of funds that outperformed, they were truly active. They followed a specific strategy, took high conviction positions in what they did, and they stuck to it in times, and even when the market wasn't rewarding what they were doing, they stuck to it. And so over time they outperformed. And so that's so to diversification, there isn't a lot of benefit in that sense. There is to some, maybe on the asset class level, different aspects of that. But even in our portfolio, if you think about it, we're investing in the S&P 500, the Russell 2000, and the EFA index in international developed. Each one of those is 500 stocks, 2,000 stocks, and 900 stocks. So even in that, we're technically not really diversified, or we are diversified, right? Within each of those, even though it's only a one ETF that we're investing in at any one time. So, hopefully I answered your question. It's kind of around.
It did, it certainly did, and it's nice to hear feedback. And I think that one of the things that has made you guys successful, at least one of the things that attracted me to your fund, is that your changes are based off of rules-based. Basically, your barometers that you're using, whereas a lot of the firms that we interview, and we interview quite a bit of firms on a weekly basis as we go through our due diligence process. They're subjective based, and so that always makes me a little bit nervous when you have somebody making decisions based on a gut feeling. And so again, one of the things that attracted me to the Athena Global is that yours is completely rules based, and so based on that, kind of what you're just saying is that you don't make a change. Like we just saw a bump up in the market in the last month or so, but you guys kind of stood your ground there and stayed firm because we're starting to see a dip again. So I think rules based is something that I think that, especially when it shows that it's worked, is a superior way to invest for sure.
Right. And the reason, so the professor developed a strategy back in 2008 and 9, and he did a lot of research. There's a lot of academic research that goes into it, not just his research, but looking at other PhDs and other research papers out there to kind of validate, to see whether those ideas that we have come up with are good ideas, right? So we're looking for persistent, repeatable processes in the market that last over time. But when it comes down to the rules-based thing, we're all about emotions. This is behavioral investing, and we know it's not just the client making behavioral mistakes. The advisors make behavioral mistakes, the analysts make behavioral mistakes, and so do the portfolio managers. And so in order to drive those emotions out of our decision-making process, that's a very important part. There's motion at all different levels, and we are the portfolio manager. We're just as subject to those emotions, for one reason or another in our decision-making process. And so sticking to a set of rules that have worked, that give you an edge in the market, and following that process, religiously, you can result in good performance over time.
Yeah. So I appreciate what you guys do and how you guys have done a great job for our clients. I don't see any questions that have come through. So folks, if you have any questions, feel free to just shoot us an email, give us a call. And again, we'll send out this presentation. So if you'd like to watch it again. But other than that, hey, Dave, thanks for your time today. We look forward to seeing you again in the near future. Have a great rest of your week, everybody.
Excellent, Josh. Thanks for inviting me on, and everyone, thanks for listening. Feel free to reach out if you have any additional questions after the fact.
Okay, thank you. Bye-bye.